Hey, good morning. Accounting 230, Chapter 1. I had a little bit of trouble with the recording, so I'm going to do another recording right now of our lesson for Chapter 1. And I apologize for the inconvenience. So let's see if we can get started here with some Wiley PowerPoints, and we'll go from there. Let me set this up the way that I like it set up. It's all about me. Okay. All right. Wiley, the way they've set their, Wiley is the new publisher, by the way. For the last long number of years, we've been using McGraw-Hill. We've made a decision to upgrade to Wiley, so we'll see how it goes. And Wiley likes to begin its slideshows by talking about the objectives that we're going to attempt to teach in this session now. We're going to talk about the different forms of business organizations, the types of activities, and the 4 basic financial statements to get us started. The real guts of this chapter starts when we get to chapter 2. So let's see what we have as far as introductory information goes. Identify the forms of business information. Organizations. Sole proprietorship. Sole proprietorship, partnership, and corporation, right? Those are the 3 types of businesses in the United States. A sole proprietorship is the most common one. Sole proprietorships are the ones that really drive the economy. They're easy to open, they're easy to establish, and they're easy to close. You can just shut your business down by turning the lock on the door. The advantage of a sole proprietorship is that you have unlimited access to all the rewards. You get all the rewards, but you also get all the risks. For example, if you have a business and you invest $10,000, and at the end of the year, that business made $100,000, all that profit goes right into your pocket. On the other hand, though, if the business ends up losing $100,000, you owe, on a personal level, $100,000 to your creditors. In other words, you invest $10,000, you lose $90,000 more, you're in the hole 100. You are personally stuck for that 100,000. You have no shield at all because you're a business owner. So that's a big disadvantage, perhaps, of a sole proprietorship. But the sole proprietorship does have a tax advantage in that it's taxed on your personal income tax return at the normal tax rate. Partnerships are similar to a sole proprietorship in that they're simple to establish, but you have shared control. You have 2 or more people involved in running the business, and there can be conflicts and there can be disputes between the owners that can make things a little bit hairy. But partnerships working together can be a great source of economic development. Partnerships, you have broader skills and resources, and you have the same tax advantage you have with sole proprietorships. The income from a partnership flows directly to the individual tax return of the partner, just like a sole proprietorship. Corporations, easy to transfer ownership, easy to raise funds, and there's no personal liability. Now, a corporation is, you just can't open up a corporation in 5 minutes like you can a sole proprietorship or a partnership. But once you're set up, it's very easy to transfer ownership. You just buy stock in the company and you become an owner. So that's how corporations can raise money. They can do it by issuing stock or perhaps issuing a bond issued to the public. The nice thing about a corporation is there's no personal liability. If the company goes out of business, they're not going to come after you as an owner of the company personally. You're protected by what's called the corporate shield. Of course, that doesn't apply to fraud and malfeasance. Then that's a different story. But a company that goes out of business, they can only be sued up to what the assets of the corporation are, nothing personal by the ownership. I own 100 shares of Coca-Cola, right? I'm a part owner. Those shares are worth about $5,000 now. If Coca-Cola went out of business today and they owed 10 times that amount of money, I would not be stuck for anything more rather than the loss of my 5,000. Who is interested in the accounting information? Well, a lot of people, both internal to the company and external. Let's start with the internal people. The finance department, the accounting department, they're certainly interested. They want to know if the company's making enough money to justify maybe a dividend payment. Should they be in a position where they can expand to another store, perhaps? Management, which Pepsi Cola product line is most profitable? Should we eliminate a product line? Management, and when I say management, I'm not talking upper management necessarily. I'm talking middle management and lower management. You might have a contract with your employer that you get a bonus if they reach a certain threshold of earnings. So you are certainly interested in the accounting statements. Marketing, same thing. What products should we be selling? What products are we selling that perhaps we shouldn't be? You would be using the accounting statements to make those kinds of determinations. And human resources, personnel needs to know if they can hire more people. We'll skip Cliff Bar. Questions asked by external. We just went internal, external. Well, guess what? Investors are interested. Is General Electric earning satisfactory income? Sadly, no. General Electric is a real disaster right now, floating near bankruptcy, I'm afraid. An iconic American company that's totally fallen apart. But I digress. Investors are not going to give you money to buy your shares if you don't have good audited financial statements. There's just no way around that. Creditors, will United Airlines be able to pay its debts as they come due? Well, no one is going to loan money to United Airlines or anyone else without properly audited statements, okay? And they talk a little bit about different types of accounting positions, and I'm kind of going to just skip this for the moment. Now we're going to talk a lot about ethics, Ethics, doing the right thing. You see they're talking about some financial scandals of the past, Enron, WorldCom, Health South, AIG, and others. These were horrible, horrible accounting scandals where, in the case of Enron, they printed nothing but phony financial statements. They complicated their processes to the point where nobody even understood what they were trying to tell them accounting wise. And yet the stock kept going up and up until finally people realized that it was all a shell game. And Enron is the largest bankruptcy in American corporate history. The three perpetrators of it all served jail sentences, and one of them is still in jail. WorldCom was a technological company out of Mississippi, where the ownership decided they wouldn't record any expenses, if you can believe this. Every penny they spent, they put it on the balance sheet as if it was an asset. Well, you can only get away with that for so long, and WorldCom got theirs. I'd like you to be familiar with the Sarbanes-Oxley Act, okay? SOX, like Boston Red Sox. Sarbanes-Oxley Act. This came in the wake of all of those malfeasances you see above there. It was a law that forced management to acknowledge they know what the heck is in their financial statements. Before Sarbanes-Oxley, a company would churn out financial statements that turn out to be dead wrong or perhaps even fraudulent, and upper management could say, hey, I'm just the president of the company. I'm an idiot. I don't know anything about the accounting. Talk to Mary over there. She runs the accounting department. Those days are over. Now they have to, upper management must sign off that they read and understand the financial statements, and they can be personally held, even though it's a corporation, if they've engaged in some fraud. When you're talking about ethics, you have your own ethical pool. Use your personal ethics. Some companies will give out a written code of ethics that can be very helpful. When you're talking about a dilemma, identify the stakeholders. Who are the people affected by this? Who's going to be hurt? Who's going to be harmed? What are the responsibilities and obligations of the people? In other words, select the most ethical alternative considering all the consequences. Weigh the impacts. Some situations involve more than one right solution. You want to choose the solution that does the least harm and most benefit to people involved. I felt the pressure. Yep, even in the corporate world, there's that peer pressure. I felt the pressure. That's what some employees of Dewey and LeBoeuf indicated when they helped to overstate revenue and use accounting tricks. And then on the bottom, I was instructed by the chief financial officer to create invoices knowing they would not be sent to clients. When I sent these invoices, I knew that it was inappropriate. You knew it was a crime when you did that. You knew that was a crime. In other words, they're telling the world they have all these sales when they really did not. And they use those phony sales to borrow money and keep the fraud going even worse. I felt the pressure. I intentionally gave the auditors incorrect information. Same thing here. Do the right thing, please. In choosing your organization, consider the pros and cons of each. Easier to raise funds, that's corporation. Corporation, all it has to do is issue stock to the public and they shall receive investors' money, okay? What's simple to establish? Not a corporation, but a sole proprietorship and the partnership. Which one has no personal legal liability? It's protected by the corporate shield, the corporation. The corporation does not have the tax advantages that the sole proprietorships and partnerships have. Corporations have a double taxation where they're taxed first on their income and then they're taxed on dividends. And what's easy to transfer ownership, that's a corporation. You own stock in a company. If I wanted to dump my 100 shares of Coca-Cola today, I could just hit a button on the computer and they're sold that quickly. It's not so easy to do that with a sole proprietorship or with a partnership. Which of the following did not result from Sarbanes-Oxley? Well, they didn't change any tax rates on corporations because of that. But let's concentrate on what it did do. Top management must now certify the accuracy of the financial information. Hard to believe that wasn't required earlier. Penalties for fraudulent activities are increased. You get caught goofing around now, you're in big trouble. And the independence of the auditors was increased. They were given more empowerment to look into the financial statements. Learning objective 2, 3 types of business activity. And we got a whole chapter coming up just on cash flows. And that's what we're talking about here. All businesses are involved in 3 types of activity: operating, investing, financing. I'm saying them that way in that order deliberately because that's how they're presented on the cash flow statement. Operating cash flows represent those monies that are being generated by what the core mission of the company is. In other words, my beloved Coca-Cola, they manufacture soda, they bottle soda, they sell soda, they send invoices to people to pay them for soda. They've got their snack line of snack foods. They've got other beverages. Anything involved in the normal course of a soda business is operating for Coca-Cola, and that's where you want to see your positive cash flows. Investing is buying a large truck, a building, land, perhaps another type of big vehicle or machine. Investing, that's big ticket items that you're going to keep for a long time. It's also considered investing if you buy stock in another company. Bill Gates at Microsoft, he's got tons of money sitting around in Microsoft's checking account. He could right now go out and buy millions of dollars worth of General Motors stock. That would be another example of investing. Financing is simply raising money. Financing is borrowing. Financing is issuing stock to the public. So with financing, we're either issuing stock to the public or we're borrowing money, perhaps in the form of a bond issue. Financing activities, borrowing money. And when we borrow money, we're going to set up what are called liabilities. Liabilities, that's a debt. That's an IOU, a liability. They're the parties to whom the money is owed. Notes payable and bonds payable. Financing activities. The other financing activity is here. You issue stock to the public. You announce to the world that you're issuing 1 million shares of $1 par value stock, and then the market price will be determined by the reaction from the secondary market. Depends how many people buy your stock and how the price moves. And when you're going to make a payment to the stockholders, kind of as a reward for holding the shares, that's called a dividend. And that's a reduction in the company's net worth. A dividend is not an expense. It's a reduction of the company's capital. Investing, like we were just saying, computers, delivery trucks, furniture, buildings, big, expensive, big ticket items, or you buy stock in another company, or you buy the bonds of another company, or you invest in rare coins or something. You get the idea. And here's what the ones where we do want to see the most positive activity. Operations begin once the company gets assets, revenues are generated, amounts earned from the sale of products. So all your sales revenues, service revenue, whatever you might have, that's your positive cash flow. Inventory is a part of operating. So we're buying and we're selling inventory. Accounts receivable is a part of operating. We're going to be selling goods on credit, which means that we're going to get paid later. And that type of activity is recorded in an account called accounts receivable. And we're going to reduce accounts receivable when we get paid. Operating. The expenses involved in the normal course of business, those are operating. Cost of goods sold, selling expense, marketing, interest, etc. And liabilities arise from expenses. And guess what it says at the bottom of this slide? Net income when revenues exceed expenses, net loss when expenses exceed revenues. I don't think you needed to come to college to know that. When your sales exceed your expenses, you made money. Classify each of the following as an asset, liability, common stock item, revenue, or expense. Let me interrupt, though, to say the accounting equation is something you need to know immediately. Assets equal liabilities plus capital. Assets equals liability plus capital, or you can call it equity or the net worth. Assets equals liability plus capital. That must remain in balance at all times. It's the whole basis and structure of accounting. So we have assets equal liabilities plus common stock plus revenues minus expenses. That's your accounting equation fleshed out. So let's see what we have here. Cost of renting property. Yeah, you're right. That's an expense. Truck purchase, that's a big item. That's an asset. Whenever you see the word payable, like notes payable, that's a liability. You issued stock to the public. It was common stock. You earned money from selling your product or service, revenue, and you owe money to your suppliers, liability. Learning objective 3, the final learning objective. Describe the 4 financial statements and how they're prepared. And get ready to look at this for the next 2 years of accounting, or 4 years if you're going to major in accounting at UCSB or elsewhere. 4 financial statements. We have the following statements. We have an income statement, a retained earnings statement, a balance sheet, and the statement of cash flows, okay? The international note we will ignore. We're not going to talk about international in this course. So take a quick look at your income statement. It's pretty basic, huh? We have Sierra Corporation. Always put the name of the company on top. Income statement. And then for the month ended, you want to say for the month of, or for the month ended. In this case, October 31, 2022. Wow, they're going way in advance. They already know what their net income is going to be. Service revenue was $10,600. We simply then list the expenses like salaries, rent, supplies, depreciation, etc. And we have total expenses of $7,740. Net income, $2,860. The income statement gets a lot more complicated as we build more and more knowledge into it. But this is basically it. It is sales minus expenses, net income. You must do the net income first. When you're doing your homework, in this chapter. If you haven't figured it out already, you have to do the net income first before you can do the next statement, which is the statement of retained earnings. So we got to look there at the income statement. Let's take a peek at the statement of retained earnings. Sierra Corporation again, retained earnings statement. Retained earnings. What retained earnings represents are the income and losses that have been piled up over the years since the company began. This company started October 1st, 2022, so they had no retained earnings. Then they had that net income, remember, of 2860. That 2860 is now going to be brought down to the retained earnings statement and added to the beginning. So the beginning retained earnings plus net income gives us a dollar amount. Retained earnings, think of it this way. This is the end of the first year for this company. They have $2,860 sitting in retained earnings right now. If they made another $3,000 next year, they'd have $5,860. If they had another $3,000, they'd have $8,860, etc. Now, what reduces net income is if a company very kindly and nicely hands out dividends. So this company did. They gave away about 1/5 of their net income in the form of a dividend. So this report is simply beginning plus net income minus dividends equals the ending retained earnings. Bide your time, BIDE. You like acronyms? I happen to kind of like them a little bit. BIDE, bide your time. Beginning retained earnings, I for income, D for dividends, E for ending. Bide your time. So what this shows you is what happened to the retained earnings. It went up a lot by the income, and then we dropped it down by giving away part of the company. So here you can see a visual of how the net income, the income statement is done first, and then that net income is brought over to the retained earnings statement, and we subtract the dividends. The net income is needed in order to do the retained earnings statement. Can't do it without the income. And now that we have done the retained earnings statement, we can do the balance sheet. The balance sheet. So here they're showing us the balance sheet. You see the 2,360? That's the number we want to see on our balance sheet now. And notice that the balance sheet balances. Assets total 21,910. Assets equal liabilities and stockholders' equity. So we are in balance. The balance sheet is a snapshot in time. Sierra Corporation balance sheet. Notice that it says October 31st, 2022. That's different than the headers here where it was for the month, for the month. You can't say for the month on a balance sheet because it's a snapshot. It's a picture in time. As of midnight on October 31st, we had 15,200 in cash. Customers owed us 200. We had 1,000 in unused supplies, etc., etc. It is a look at the financial position of the company at that point in time. Balance sheet, report assets and claims at a specific time. We can skip that. And here you see the relationship of the retained earnings statement going over to the balance sheet. We came up with the new retained earnings, and that goes here. Before we did this, retained earnings was 0. So the capital at the beginning was 10,000. The only capital they had was they issued $10,000 worth of stock. Now they've got some retained earnings on top of that. The net worth of the business has grown by that amount of 2,360. We'll just look briefly at a cash flow statement. We've got a whole chapter coming up on this in a month or so. We have 3 sources of activity, remember: operating, investing, financing. Let's remember what they are, get familiar with them. Operating is whatever the company normally does to make its product, to sell its product, to pay its suppliers, to pay its employees, to collect money, etc., etc. Operating. So in this example here, operations provided $5,700. That means our cash went up by 5,700 due to normal operations. But look how it's offset here with investing. Well, investing, we took off 5,000 to buy perhaps stock in another company, or we bought a machine or something, a computer. So that's a negative cash flow. So those two kind of zero themselves out. When you say the difference is only $700. What happened with financing? Well, look at this. They issued that $10,000 worth of stock we saw on the balance sheet. They issued some notes. They went out and they borrowed money, and they had to pay some dividends. When you're paying dividends in this situation, that's part of financing. So the net cash provided by financing is $14,500, and it serves to show pretty much where the increase in cash came from. The cash flow from operating, plus or minus the cash flow from financing, plus or minus the cash flow from investing, has to equal the change in cash from the beginning of the month to the end. So in this case here, they had no cash at the beginning. The company hadn't even started yet. Now cash went up. You're sitting in a meeting with your boss at month end, and the boss says, well, how do we do? You say, well, boss, cash flow was positive 15.2, but only 57 of that came out of operating. Remember, boss, we spent $5,000 to invest in that new computer system, and we also issued common stock and notes payable to get us started. So that's how you might explain the cash change. And what that report does is what we just described. Where did the cash come from? How did we use it? What was the change in the cash balance? And once again, they're showing the relationship. These are good slides. Cash at the end of the month was 15,200. So we show it here, cash at the end of the period, cash at the beginning, cash increased. Why did it increase? Mostly from financing activities. Net income will result during a time period when revenues exceed expenses. Revenues are higher than expenses. Revenues and expenses have nothing to do with assets, really, or liabilities. Revenues, you sold something for $100 and it cost you $40 for your expenses. That's your profit of $60, okay? Which of the following financial statements is prepared at a specific point in time? Remember the snapshot we said for the balance sheet? The balance sheet is the one at a specific point in time. The balance sheet is a snapshot. The income statement, retained earnings, and cash flows, that's more of a movie. That's showing what's happened from the beginning of the month. Every day, numbers are accumulating, going up, up, up till the end of the month. Let's have a little fun with this now. They're asking us to prepare an income statement and a retained earnings statement and a balance sheet from this information. Good gosh. Well, which statement do we prepare first? Well, they're giving you a hint. We have to do the income statement first. And what is the income statement? It is sales or revenues minus expenses. And I'll give you a hint. Anything that's a revenue is going to be called a revenue here, and anything called an expense is an expense. So we're going to set up our income statement with the name of the company, CSU Corporation, income statement for the month of, or for the month ended December 31st, 2022. And then we're going to find the revenues. So let's see, accounts receivable, that's an asset. Payables, that's a liability. Well, here's one expense. We know we have one expense there. Oh, here's our revenue, 17. Our expenses are rent, insurance, supplies. I see 3. So let's take a look at our income statement. There it is. There it is, simple as that. 17,000 minus your 3 expenses, add them up to get the total expenses. There's your net income, okay? Well, now we have to do the retained earnings statement. And what was the beginning retained earnings? 0. We had none to begin with. What was the income? $6,800, right? That increases retained earnings. What reduces retained earnings? That is correct, dividends. So we should see a report that says CSU Corporation retained earnings statement or statement of retained earnings for the month ended or for the year ended. And let's see what we have here. Pretty easy. Bide your time. Beginning, 0. Add income, less dividends to get to the ending. Now that we have the retained earnings done, they now want us to prepare a balance sheet from these numbers, huh? So now we have to figure out what goes on the balance sheet. Remember, the balance sheet is an expression of the accounting equation. It's going to list all of the assets on one part of the page, and then on the other side, you're going to see all the liabilities and the equity accounts added up, and that total must equal the assets. So let's see what we have here. I'll go through it with us here. Accounts receivable, that's an asset. Let's see if we can figure out the assets first. Accounts receivable, payables, that's not an asset, that's a liability. Expense, we already used that. That's a liability. Common stock is part of equity. Equipment, that's certainly an asset. So it looks like we have 2 assets so far. Accounts receivable and equipment, insurance expense and revenue. Supplies, when you see the word supplies by itself, that is an asset. Those are supplies we have not consumed. Supplies don't become an expense until we actually use it. We bought a bunch of cleaning fluid to keep the building clean. When we buy the supplies, it's an asset called supplies. When we use it, then it becomes an expense and we figure out how much we used. So supplies is another asset. And I see a 4th asset, I see cash. So now we want to list them in the proper order. They're going to be listed in order of liquidity. Assets and liabilities are listed on the balance sheet in order of liquidity. Liquidity meaning the ease in which you can turn it into cash. There's nothing more liquid than cash. Cash is liquid. Accounts receivable is more liquid than supplies, which is more liquid than equipment. So I'd expect to see our assets be cash, accounts receivable, supplies, and equipment. Here it is. Cash, accounts receivable, supplies, and equipment. $23,200. Let's go back and see if we can figure out the liabilities and capital. Well, let's see here. Accounts payable, and let me give you a hint. It's a liability if it says payable, okay? So we have accounts payable. I see notes payable. I don't see anything else. So it looks like we have 2 liabilities, and here they are. Here are the 2 liabilities. Notes payable, accounts payable, gives you a total of 7,000 liabilities. Equity, well, common stock is part of equity, part of net worth, part of capital. They gave us a question mark for retained earnings, but we're smarter than that. We already figured out the retained earnings. So that question mark is $6,200. Here's our 10,000, 62. Total equity adds up to 16,200. Add them all up, 23,200 equals 23,200. The balance sheet. And companies hand out annual reports with financial statements and discussions and analysis and looks at the future and a lot of notes and auditors reports. You're going to be working with the annual report of a couple of corporations in a few weeks when we assign your first FSA project, financial statement analysis project, where you're going to dig into 2 companies and provide a write-up of what you see and what you think about the company. The annual report, I'm not sure we need to go over this just yet, but the annual report is done by the corporation, obviously, and they put their best face on it. The annual report always has pictures of happy people using their products. You look at the cover of, say, Pepsi-Cola, and I almost guarantee there'll be some young-looking person there sipping on a Coke and just loving how wonderful it is. The real report you're going to work with, though, at the end of the year is called the 10K. It's a report from the Securities and Exchange Commission, and that goes into great, great detail. Partial discussion. Here, they're showing you the example of a little bit of a note. Columbia Sportswear is telling the world we're affected by seasonal trends and have historically resulted in higher sales in the third and fourth quarter. So they're kind of explaining their business has some seasonality to it. They sell more in the second half of the year. Financial statements will always have very formal notes. They are really essential to understanding a company's operating performance and financial position. Here's a note here on revenue recognition. Columbia Sportswear, we record revenues when title passes and the risks and rewards of ownership have passed. Title passes on shipment or upon receipt. So they're just giving you a brief look at how they, in their world, record revenue. There's different ways. And of course, you get the auditor's report at the end of the year, and you want to get from the auditor what's called an unqualified opinion that everything is looking good. Excerpt from the audit report. When I took the CPA exam 50 years ago, I had to memorize this, and it's changed a little bit over the years, but essentially it says something like, we have checked out the financial statements of Columbia Sportswear using our normal policies and procedures as required by GAAP, and we deem the financial statements to be in accordance with GAAP as of the date stated, blah, blah, blah. Components of annual reports. I don't think we need to worry about this too much, but let's look at it. Description of significant accounting policies goes into the notes. Unqualified opinion, that's part of the auditor's report. Explanation would be part of the notes. So would the description. That's going into the management. Well, I'm saying it's part of the management discussion and analysis. Okay, I'll go with that. Same thing with description of operations. And this is part of the auditor's report, okay? We're not going to worry about international, skipping that. And that is the end of our discussion, the end of our class, okay? I'm sorry for the lousy picture where you just see me in shadows, but I did panic a little bit when I realized somehow, some way, I either lost the original live lecture I did, or I'm just having trouble locating it for some reason. So this will have to suffice. So thank you, everybody, and I'll see you on Tuesday, I guess, okay? Our next Zoom session. You take care now. Bye-bye.